Hormuz risk is no longer just a possibility, it is being priced. According to Reuters, tensions in the Middle East pushed oil higher and brought inflation expectations back into focus. At the same time, Federal Reserve officials repeated that it is too early to cut rates, so an energy shock arrived and central banks stepped back. So here's the real question: how much will this push inflation higher this year? And how much of it is already priced by markets? The Hormuz crisis is no longer just a geopolitical headline, it is becoming inflation itself. According to Reuters, tensions in the Middle East pushed oil prices higher and brought inflation expectations back into focus. At this point, the key chain begins. Oil rises, leads to energy costs, increase, leads to transportation, becomes more expensive, leads to production costs, rise, leads to inflation moves higher. And this is not just a theoretical chain. In 2022, after the Russia-Ukraine war, energy prices surged and inflation in Europe moved into double digits. This is exactly what markets are afraid of now. But this time the difference is clear. Markets are not waiting for the event, they are pricing the probability. And this brings us to central banks. Federal Reserve officials have repeated that it is too early to cut rates. The reason behind this message is simple. When there is a risk of energy-driven inflation returning, cutting rates becomes risky for central banks. So markets are not just pricing oil, they are repricing the rate path. This leads to the second key chain. Oil rises, leads to inflation. Expectations increase, leads to central banks wait, leads to rates stay high, leads to liquidity remains tight. The impact of this chain is most visible in growth stocks and crypto, because these assets depend on cheap money. And when money stays expensive, upside becomes limited. Now let's look at how markets price this. These types of shocks are not priced in a single move. They usually unfold in 3 stages. Stage 1, shock hits, oil spikes, markets initially sell off. Stage 2, markets pause and ask, is this temporary or structural? Stage 3, if the shock looks persistent, pricing shifts deeper into inflation and rates. Right now, we are in stage 2. Markets are not in panic, but they are not comfortable either. That's why we see both rallies and sell-offs within the same week. There is also a psychological layer. Markets do not price certainty, they price probability. So even if Hormuz does not fully shut down, the risk alone gets priced. That's why price moves often come before the actual event. Now let's look at sectors. Energy companies usually benefit from higher prices. Defense stocks are supported by geopolitical risk, but technology and growth stocks may face pressure as rate cuts get delayed. Gold tends to act as a hedge in these environments. Crypto is more complex. Bitcoin sometimes behaves like a risk asset, sometimes like a store of value. But in general, tight liquidity makes it harder to build a strong trend. Historically, this is not new. In the 1970s, oil shocks pushed inflation higher and forced central banks into aggressive tightening. We saw a smaller version of this in 2022. And now markets are asking one question: is this a temporary shock or the start of a new inflation wave? The conclusion is clear. Hormuz risk is no longer just an energy story. It is a macro turning point that affects inflation, central banks, and valuations, and markets are pricing it step by step. But the most important question is still unanswered. Will this crisis stabilize or turn into a new wave of inflation? As the United States presidential election approaches, this becomes even more critical. Because during election periods, geopolitical risk and energy prices can directly shape market direction. And central banks are the key players here. Federal Reserve and other major central banks need to see whether energy-driven inflation becomes persistent. If this pressure continues, rate cuts may be delayed. If tensions ease, markets may find relief again. So there are 2 possible paths. Either this remains a temporary shock, or it becomes the beginning of a new macro cycle. And this is exactly what we will be watching, where this chain between oil, inflation, and central banks breaks, and how markets price that shift. Because from this point on, what matters is not the headline itself, but how this balance evolves. We talk markets, not noise. D&D.